Which is the best stock to buy, NIO or Sofi Technologies? This is an interesting comparison because we've got a Chinese EV company compared against a US bank slash financial services company. So it's interesting comparing these two very different companies. I'm going to do that in this video using some vital financial metrics I'm going to compare the two on. And then on the end of the video, I'm going to answer which one of these two is the best stock to buy. So let's get into the details. With revenue for the trailing 12 months, you might be surprised to see that NIO's revenue over the trailing 12 months was an impressive $7.3 billion. That's a much bigger company than SoFi with trailing 12-month revenues at $1.574 billion. But both of them, you notice here over the years, are growing rapidly, revenue exploding for NIO and growing at a healthy rate for SoFi Technologies, both expected to grow at a robust rate of growth for the next several years. So you could look for these companies to continue expanding, continue growing for the near term. The next metric I wanted to compare these two on is on income from continuing operations for the trailing 12 month. So this is income the companies make from their day-to-day operations, right? In their core business, not income from the one-off type events that might happen in a company's business, like for example if they invest in a company and the investment that they made, the stock price of that company goes up, that shows up on the company's net profit statement. I wanted to exclude that for this metric. I just wanted to look at its core business, how good they are at turning profits from their core business, and this metric tells us that. And according to this metric, SoFi lost 320 million in the trailing 12 months in its core operations. But it's improving, it's getting better, right? Making progress. Meanwhile, NIO lost 2.11 billion in its core operations, and it's getting worse. And it's getting worse. It seems like the more revenue NIO captures, the more it loses in its income from continuing operations. That's not a good sign. That's a red flag for me. To lose money in a growing business, I find acceptable. However, I want to see progress towards profitability as you grow your revenue. I don't like to see this opposite directional movement here from that I'm seeing from NIO. So on revenue of 7 billion, it lost 2 billion, while SoFi on revenue of 1.6 billion lost 320 million in cash in continuing income from continuing operations. Next, I wanted to look at net income, right? So this is a more comprehensive figure. This is quarterly net income. And again, I see a similar trend where SoFi is improving, right? Still losing money on the bottom line, but making progress. And NIO moving in the opposite direction, right? Going downward. 821 million in losses in net income. So what this tells me is NIO still has a way to go before it reaches profitability, even though the company has told us, management told us that they could be break even by the end of fiscal year 2024. SoFi actually told us they're going to be GAAP net income profitable this current fiscal year. So and that makes sense. They're closer to profitability here. NIO is not as close as SoFi is to profitability. Finally, I wanted to look at the two companies' valuation, and since they're both losing money on the bottom line and cash flow negative, I chose to use the forward price to sales ratio to compare the valuation for these two stocks. And looking at this metric, SoFi is trading at a forward price to sales of 2, and NIO is at 0.8. So if I had to pick the best one of these two stocks to buy, I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I would choose SoFi. I would choose SoFi because they are closer to profitability. They are making more progress, and management has told us they're going to be profitable in the current fiscal year. Meanwhile, NIO is not expected to be profitable until 2024. And I'll say this one thing though at the end is both of these companies are experiencing significant headwinds. Electric vehicle sales in China so far in 2023 have slowed down considerably compared to last year. That's because the government has removed incentives to consumers to buy electric vehicles, and so that has significantly slowed down sales. And on top of that, you have all of the companies that are participating in the Chinese EV market lowering prices, so competition is becoming more fierce, and that's never good news. And then for SoFi, if you're in the US, you will have known, actually around the world now, that Credit Suisse participated in the rising bank failures and bank risk. That's happening as depositors are taking money out of their bank accounts and putting them into money market funds or buying government treasuries because interest rates are higher. So if banks are not giving you that interest rate to keep your money in the bank, you're taking it out and you're moving it somewhere else. SoFi is a little bit protected from that because it offers a very good savings rate for keeping your money at SoFi. However, if this bank run trend continues, SoFi could be in trouble too, because customers will say, I don't know, SoFi is not one of the big banks, so maybe I want to take my money out from SoFi and put it in Bank of America just to be safe, even though SoFi is offering a much better or APY, a much better savings rate for keeping your money there. If you've got more than 250,000, the government will give you insurance up to 250,000. If you've got more than that, you might say, I don't want to risk having my money tied up in an institution while the government may not protect my funds above that. I'd rather put it in the safest possible institution, which might be which consumers might view as the largest U.S. banks, the largest, maybe J.P. Morgan or Bank of America, whatever the safer bank would be. SoFi is a newer, younger bank where consumers may not view it as safe as some of the others. Now, I'm not saying it is or isn't as safe as some of the others. I'm just saying what consumers may think it to be, because right now this is a game of perception. This is a game of psychology. If consumers think that SoFi is not as safe as JP Morgan, then they might take their money out of SoFi and put it into JP Morgan. And if that continues, that bank run will be bad news for SoFi. So each of these companies facing significant headwinds. So they are higher than average risky stocks, but they also come with a higher than average return potential. All right, so if I had to pick one of those again, I would say I would pick SoFi, but I will warn you, they're both very risky right now because of the headwinds they are facing. All right, as always, thank you so much for watching. I've hand selected some videos that I think you'll enjoy that are popping up on your screen right now. So please click on one of those and I'll see you over there. Thank you for watching.